with everything that's been going on in the real estate market recently, because it's been really weird. Really interesting, crazy things that have been happening. Like we've been seeing multiple offer situations despite rates being in the 6%. Rates did actually go down. Like they went above 7% for a little while. Now they're about 6.3. So they're getting into the low sixes again. And hopefully soon we see them below 6. That'd be great. So anyways, it's just been really interesting. It's been a really interesting real estate environment right now. So I did a deep dive into the real estate market and what's been happening right now. I followed a lot of Barry Habib. I highly recommend you look into him if you want to go look and do the research yourselves. He's a great guy. He has a lot of really good information. He even goes and speaks to the Fed about what's happening in the economy. So this is going to be going into a lot more detail than we usually do, and I hope it's helpful for you. It looks like we're headed towards a recession. There's a variety of reasons for that. Just looking at people's savings and their credit card balances, I thought these were two very interesting graphs. First off, this top one's credit card, this one's personal savings. This gray, this is when COVID hit and we went into a brief recession. So credit card balances are going up, personal savings were staying about level. We hit COVID. There was this recession. We got a stimulus check. Savings went up very quickly. And then credit cards went down very quickly. Savings went down. You got to take the money from your savings to pay off your credit card. So that was really cool. That was great. Lower credit cards, more savings. Who doesn't want that, right? Got to the second stimulus check, and we spent it pretty quickly. Got it spent. Got the third stimulus check, and we spent that one just as fast, if not a little bit faster. And from there, that was it. We as a whole seem to really enjoy the stimulus check lifestyle, though. Like now we're going out and we're getting all these things we couldn't before. And now no more stimulus checks are coming, but we still want to maintain that lifestyle. So our savings started to go down and our credit card balances went up dramatically. So it does look like we are heading towards a recession. Now, that's always bad news, but it's not the worst news. There is some good news with that as well. So from there, going on to the next graph, every time we hit a recession, this is, again, the gray bars, these are all recessions since 1972. Every time we've hit a recession, the interest rates have gone down. So back in 1980, they were at 16%. Hit a recession, went to 11.75. And again, they went down here, and here, and also right here in 2020. So every time we hit a recession, historically, interest rates have gone down. So if we hit another recession, that wouldn't be the worst thing in the world. Now, there's different ways of looking at that. Unfortunately, recessions are always hard for everyone. They're not great. A lot of people lose their jobs during those times. At the same time, just on your home buying journey, let's say you're one of the lucky people who don't lose your job, you get to keep your job. As interest rates go down, for every 1% drop in interest rates, you get about 5 million more people who can now purchase a home, who now qualify to purchase a home. So as rates drop, your job is stable and steady and it isn't affected during that time. The good news is that you'll be able to qualify for a larger house. So then from there, what's really interesting is looking at how supply and demand works, right? Because when there's so many houses for sale, and we're going to kind of like compare the differences right now between what happened in 2008 and what's happening now. When you're looking at houses for sale and active inventory and the demand that we have, because it's all about supply and demand. In 2008, we had a massive amount of supply. And now we don't have very much supply. And we'll go over that a little bit more in a little bit. But when you're looking at supply and demand, the part of supply that matters the most is new homes that are being built. The reason why is because if your house is for sale and you're buying another house, it doesn't really do a whole lot because you're representing both the supply side and you're representing the demand side. Now, we're always getting more demand because we are a growing population. The U.S. as a whole, though, I believe it is actually starting to level off. But, we have people entering the market, we have people leaving the market. So what really makes a difference is new homes being built. So as we're looking at this graph and we're looking at homes that were built over time, you can see that there was a lot of homes that were being built back in 2007, 2008, all leading up to there. And they were being completed. And as the crash in 2008 happened, that went down because they had a crazy ton of supply and they couldn't handle it. There was not enough demand. And with so much supply and very few people looking to buy homes, prices dropped dramatically, sometimes as much as in half. Now, as time's gone on since then, they've slowly been starting to build more and more homes. And as you know, if you're trying to buy a home in like the last couple of years, you are well aware of how slow and how hard it is to find a home that you really like because there's so little inventory. And the home that you really like isn't for sale. And that's why prices have been going up because now we have a lot of supply and, not very much supply and a lot of demand. And the builders, you can only build so fast. Like, see how they started building more and more and more homes, but they still aren't able to keep up with how much demand that we have. So, continuing on from there, what's really interesting, this part I found very, very fascinating. The average age for a home buyer is 33 years old. So, going back to here, in 2007, 2008, 2006, this whole time, we had a lot of homes that were being built. Now, the interesting part is when you go back and look at this population group, 33 years ago, that was about 1973. So, in 2006, look at being 33 years later, you can kind of compare these. So in 1973, you look at this population chart, it drops off right there at 1973. Now, I'm not trying to, people get very, very picky about this, so I'm not saying anything about politics, just really interesting thing to note. In 1973, abortions were legalized. With abortions being legalized, the birth rate dropped. Makes sense. And now, 33 years later, in 2006, it drops off as well. It looks identical. This graph compared to the population graph. Drop and then drop. And back here, drop and then drop. But we still had all these homes. And so that's where we ran into our problems. And so now we have the problem of having way more demand than we have of supply. And it's interesting because then, going to this one, now we're in 2023. 33 years before that was 1990. And you notice that's when there was this big spike in birth rates, which means all these people, this spike in people, are now hitting that average home buyer age of 33 years old. So now we have a lot more people coming into the market to purchase a home, but we don't have enough homes available for them. which is why we have such low supply today, and why it's, even though, like, if you guys have been actively shopping right now, you know that even though rates are higher than they have been in the last, since last year, regardless of that, we're still seeing multiple offer situations. Now, the multiple offer situations are massively different than they were a year ago. Last year, it was a multiple offer situation. The home would sell for $100,000 to $200,000 above the asking price. Today is a multiple offer situation, and the home's probably not going to go that much over the asking price. Most of those offers are lowball offers because buyers now, they know that they can go in and they can make a lower offer, not like a crazy low offer, but they know that they can negotiate. So that's been kind of fun to work with right now. But anyway, so if you're shopping, point being, if you're shopping right now, there's multiple offers on a lot of these homes. So then continuing on, another reason that we're likely not going to see even though rates are higher and we have all these things happening, we're not going to likely see a similar thing happen that happened in 2008 where prices just fell off a cliff, is when you look at the average loan to value of homes. Back in 2008, homes were only paid down about 81%. But now, in 2022, just last year, it was down to 42%. So now with that, when you're in a pickle and you can't make a payment and you need to go sell, you can sell very easily because you have so much equity in your home. Before, way back here, equity was a big challenge. You didn't have the equity to sell. And that's why we had all these short sales and all these foreclosures, and there was a lot of problems, a lot of problem loans. There was a lot of things going on there. But now there's low supply. People have good loans on their homes, and they have a lot of equity already built into their homes. So, and this is I just thought this was helpful, so I thought I'd throw it in there. Just looking at the supply, we know from 2007, 2008, it was up here. This is nationwide. Across the US, we have about 4 million homes for sale in 2007. Now, we have just under 1 million homes. We want to be here somewhere in the middle. We want to be about at the 1 to 2 million range. But here we're at 980. And not only that, even though we're at 980, that is including homes that are currently under contract. About half of those are homes that are actually have accepted an offer. And there's some intricacies of when you've accepted an offer, but you're still in a way, you're still on the market, but you're under contract. About half of those have actually already accepted an offer, and they're just considered active under contract, being that they can still receive backup offers because the buyer hasn't removed their contingencies. So really, this is about here. So it's a really interesting time. We're likely, very, very likely, no one is expecting to see homes fall off a cliff like they did in 2007, 2008, just because of this massive decrease in inventory and supply. And as we looked earlier at the population chart, how there's a lot of people who are generally entering the market right now. So then with that, okay, we know prices aren't just going to fall off a cliff. We know that's not going to happen. So then, but prices have been going down. If you look at them, I believe across the state of California, the CAR came out that they have dropped an average of 7.9% across the state of California. And it varies from neighborhood to neighborhood. I've seen some neighborhoods go down as much as $200,000. I've seen some other neighborhoods barely get affected and maybe go down like $20,000. Different neighborhoods are different. So with that, how do you time the market? Like, because you want to be smart. Houses are expensive, and you want to spend your money in a smart way and make a good financial decision. So if we're looking at this as the market, this is the bottom, this is heading down, this is heading up. Most people, when they're trying to time the market, they come in about here. They come in as on the way up. And the reason for that is because no one knows when we're at the bottom. Because there's so many factors, there's so many things that go into it that no one knows when we're at the bottom until you're a few months past it. And even then, what if you are a few months past it, you went up and you're like, oh, that must have been the bottom back there, and now we're right here, but instead it goes down further. You don't know. You never know. The real estate market is very, very interesting. Every economist has been wrong at this point over something or another. So, ideally, everyone wants to buy right here, but no one knows when we're right here. So the best time really is to buy is right here, because when you're right here, that's when the buyers have all the leverage and the sellers have very little leverage. Because when prices are going down, a seller isn't going to take less than their home's value for their house unless they're really up against a wall. So the best time to buy is when you're right here. And so far, I would say, looking back over the last several months, I would say that was near like November, December of last year was when we were right about there. Now we are on this side of the downward swoop. We're on our way up, and now it's definitely more balanced. It's nowhere as near the seller's market that it was last year, but it is absolutely more of a seller's market than it was 4 or 5 months ago. But it is more balanced between the two. That said, as mentioned before, markets are crazy. Everything's happening. If you watch the news, everything's going up in flames, and you know that anything could happen. And you know that everyone's has tried to predict what was happening in the future, and everyone has been wrong. So just putting that out there. So let's look at the current real estate market and look at an example of a home that is going for $500,000. Let's say you have a mortgage for $400,000. You have it, paid a 20% down payment. For every additional 1% on the mortgage for that home, for every additional 1% increase in interest rates, you will be paying an additional $257,000 a month. Over a year, that'll come out to be $3,084 a year for every 1% higher of an interest rate that you have. Now, so that, $3,000 a year, that's a lot of money. That's not fun. No one wants to pay that. Now, that said, you can negotiate when you're purchasing this home now much more than you could before. Before you had to pay way over. Now you don't have to pay that much over. So let's say you get a 2% discount, which is definitely not unheard of, as you're purchasing this house. Now, you saved $10,000 because now you weren't purchasing this home for $500,000. You're purchasing it for $490,000. Now you take that at the expense of an additional $3,084 every year. So if you kept that interest rate for 3 years, that savings that you made is going to be wiped out in additional payments to the lender, unfortunately. But what happens is that's not the end of the story. So you have this home that you purchased for $500,000. You're with an additional 1%, you're paying an additional $257,000 a month, which is $3,084 a year. You saved $10,000. You can save $10,000 when you're purchasing this home right now because you can negotiate way more. As rates go down, which we are expecting to come, especially if we go into a recession, like when recessions come, rates go down. So we're expecting rates to go down. As rates go down, prices go up. As rates go up, prices go down. Simple. So as the rates go down, you get an appreciation as well. So you bought in this high rate environment. You saved money because you're able to negotiate and get that house at more of a discount. Now, prices are going up because rates are going down. So your home appreciates. We'll just keep it simple and do a somewhat small number. It only appreciated $15,000. But that's $15,000. That's really nice. So now you have a positive $25,000. But we'll just say you paid a year. Maybe for this example, I calculated in a year. We could argue 2 years, but in this example, we'll say a year of increased interest rate because, they're just saying they're 1% higher. We determined earlier they're going to be paying $3,084 addition in a year. That plus the cost to refinance your loan. Typically, that goes about $500, but let's just throw in an extra $1,500 for the sake of maybe you paid for that loan for a little bit longer than a year. You put in a little bit more than this. So we'll just take out $5,000 for the cost of refinancing your loan and also for the additional interest you paid over that time. You get a net growth of $20,000, a net gain, because you had that additional $10,000 in this example that you were able to negotiate to get. As rates went down, prices went up and you got appreciation, and the money you lost was just additional money you paid in interest and the cost to refinance, which we calculated to be roughly around $5,000. So you have a net gain of $20,000. So that is the opportunity to purchase a home in the current real estate market. And the farther along we get up that curve that we looked at earlier, the farther along we get up that curve, the more we'll be running away from this. So even though when you purchase a home, when rates are higher, it may feel like you're losing initially, but over the next couple of years, if it's looking like rates will be going down, and it does look like rates will likely be going down, at least according to several economists, not myself. I don't know, but following several different economists, that's what they're saying. And if that is the case, then this is the opportunity that you have. But the farther we get into seller's market, the farther we're getting away from this opportunity. So, going from there, let's look at some other opportunities that you have during this time. Because right now, with this example, we were looking at you were getting a discount. Now, let's say instead of asking for a discount on the home, you ask for the seller to purchase a buy down for you, to buy down your interest rate, which has been very common. It's been happening all the time. So let's say you're thinking like, okay, but what if I just don't want to deal with all that and I just want to keep renting? Like I just want to wait till there's no trying to time, when do I purchase, when do I refinance? You just don't want to worry about all that. And you just want to keep renting. I say fine. If you want to keep renting, that's totally fine. But just know what it costs you. Looking at the cost of your mortgage in the blue, and the cost of rent in the purple. When you pay your mortgage, so you get a fixed loan, your payment stays the same all throughout the life of your loan. And then down the road, it's not in this example, but let's say you refinance, it could actually drop, and then it's down here all the years down the road. With rents, when have you ever heard of rents going down? Like, it doesn't happen. Rents always go up. And you see this in the purple. Rents always going up. So at first, for the first year, for the same home, you will be paying more in your mortgage than you will be for rent. And year 2, 3, 4, 5 is where it gets even. And then from there on out, rents is going to be massively more expensive than it was to buy. But let's say this is taken into account just your payments. If we take into account the appreciation that you will have gained from your home's going up in value, and we take that into account and we average it over the course of your payments, we get this. You're still in the negative the first year. So if you're going to move somewhere and you're only going to live there a year, please rent. It would be a really bad decision to buy a home if you're only going to live there a year, because their home's not going to go up in value that much in just 1 year. It is very expensive to sell a home, and you have a lot of closing costs. So overall, you're going to be in the negative if you sell in year 1 versus if you rent. In year 2, you have a slight gain. And every year from thereafter, you have more and more gain. Let's say you make it all the way to year 9, you can make $200,000 from choosing to buy instead of choosing to rent. The gatekeeper is year 1. So if you can get past year 1 and get past that higher payment that you'll have in year 1, then you'll be able to get all of this appreciation and the savings that you otherwise wouldn't have if you were renting. Now, in addition to that, I don't know if you're like me, but I personally, if I don't have to keep track of something, if it's not going to benefit me to keep track of something, I don't want to keep track of something. Life is too complicated as it is, right? So I actually make your life easy. And once a month, when you purchase a home, I send you a report on your home so you can see your home's estimated value. You can see where the current interest rates are landing, and you'll be able to see a breakdown of how much money you could save if you refinanced your home at the current interest rates. So then you don't have to worry about trying to keep up with everything that's happening in the real estate market when you own a house. You're not even looking to buy. You already own. You're wanting to live there for a while. You don't want to keep up with it. You have too much on your plate as it is. If your life is anything like mine, there's a lot going on, right? So I make it easy to track that, and I just send you a report once a month so that you can keep track of what's happening. And when it makes sense for you to refinance and lower your monthly payment, you can do that. So I hope this was helpful. Again, this is based off of information that I gathered from following Barry Habib. The reports I send out are generally done by Stephen Thomas. Well, they're always done by Stephen Thomas, but today I thought I'd go into a little bit of depth of the insights that I gathered from Barry Habib and share them with you. If you would like to look up Barry Habib on YouTube or anywhere else, he has great content, and he explains this stuff very, very well. And if you have any questions, feel free to reach out to me and I can work on finding an answer. And if I don't know the answer, I will find the answer for you. So thank you guys for listening. Thank you for your time. I know this was a longer YouTube video, but I hope it was helpful. Have a great day. Bye.